The month of August is almost over, and that means that the worst month of the year is upon us, September. Yes, it's coming, and of course, what happens over the last 90 years needs to be taken into consideration. Today, we break down what we think is happening in 2023, which turns out to be a pre-election year. Hello, ladies and gentlemen, and welcome back to the channel where we discuss stocks, commodities, and cryptos. Today, we unpack the structure of the S&P 500. It's returned back to the most traded zone, a dark pool activity area, and of course, we're seeing structural change that may be happening at this zone. We'll discuss that more in today's video. We also need to talk about Apple. While the rest of the market kind of floundered, AAPL was managing to put in a great day, getting back to the golden ratio. And then, of course, we have yields. They continue to drop, but will they into non-farm payrolls? The big jobs numbers are coming, and we also have core PCE. Let's break down markets together right now. Well, welcome back everybody to the Daily Show. We discuss stocks, commodities, and cryptos, including macro, leading indicators, and the hottest charts. If you like anything to do with markets, make sure to subscribe and watch along. We've got a lot to cover in today's video. Let's begin with AAPL. The biggest stock in the world managed to get all the way to the golden fib. More on that later, but what a critical zone it managed to do. Let's also talk about bullish percent index, something that helped us to, of course, really figure out that August was going to be a sell-off month, has started to uptick again. Is this the beginning of a real rally? Well, during real rallies, we tend to see usually quite aggressive moves on the BPSPX. And in this case, we just see these little pickups. That's synonymous with usually some type of false rally, which does dip, but it's only one indicator across the board. Yeah, we'll keep watching this one together as much as we can. Now let's go back to the data, all the way back to 1944. What's happened since that point in the US markets? Well, it turns out that February, August, and September have some statistical relevance to negativity. We know that only 44% of the time since then, September's been positive for the S&P 500. It's been about 52% positive for the Qs, but of course, as you'll notice here, it is usually the worst month of the year. The problem is that even though you can see it here on charts, it doesn't really consider everything that we need to think about. In this particular year, it's like no other. Well, actually, it's like a few others. But since 1950, we haven't had that many years where we've put in over 15% in the first 7 months. Now, when we tend to get these strong months, which average at about 21%, funnily enough, we sit on 20 this year, we tend to see a couple of things happen. An average drawdown of around -8%, however, 5% is quite probable. And of course, a overall 31st of July to 31st of December positive return, in general around 5%. At the moment, we sit at -2. So the question is, will we get the average of -8? If we did get -8, it would push us to around a 4,200 on the market, and that would be a fantastic level for us to see. Of course, so far, all we've got is mean reversion. A market selling off to the 20 moving average on the weekly, which is something we've expected for a while, but there could still be more coming in September. What's pretty clear though is that 100% of the time during years such as this, by the time we hit December, we've generally been positive. And while nothing is a guarantee, that's certainly an interesting statistic with that data taken into consideration. Where are we during normal years? Well, we're basically in a period where usually you would see something like this in terms of action occur on the charts. The problem is we're in a pre-election year, so things really change. In pre-election years, we tend to see a little bit of a recovery. Then we tend to see possibly a sell-off near the back of September into a recovery for October, November, and December. We also usually see something with the VIX such as this, which is the VIX spiking in most Septembers and Octobers. During pre-election years, however, though, as we saw before, it stays quite stable. So will we get incredible volatility? Maybe not, but will we get a choppy market up, down, and all around? It seems quite probable. And it also depends a lot on yields, which we'll look at later on today's show. Another question that everyone's asking is, what about CPI? What about inflation? Will it spike back up? Well, historically, this is the 1970s overlaid with 2023 so far. And you'll notice that we're actually following a very similar curve. The question is, do we make the same mistake that we did last time? If this happens, gold, commodities, those types of investments will be probably the most stellar for sure. So if you believe stagflation is coming, then you usually know what to do. Let's now move over to what's upticking this market. I think it has a lot to do with what's selling off this market. We sold in August most likely because of a mixture of technical overbought signals and CTA positioning being incredibly strong. Over the last week, we did see CTA positioning increase, and that's probably helped to cushion the market during this rally. The thing is, though, we've returned back to 61.8 fibs that we'll look at later on today's show together. And this is one of those things that we always need to be paying attention to. 61.8 fibs, they're no joke, and they're key levels. So if we see structure build around those, then we have to be paying attention. But interestingly, we've seen it defended by dark pool activity. Let's discuss retail sentiment. All of us were pretty much bearish last week and the previous week before that. And when we get into this 36 to 40% bear market kind of expectation, usually it means we're seeing either a temp bottom or the bottom is in. The survey report comes out very soon, so make sure to subscribe because we'll update you on what's happening with everybody else's sentiment very, very clearly. And I think it'll be on our Friday video. Let's discuss here what's going on with the S&P 500. So first up, I want to talk about the positioning of the street. Most likely, the positioning of the street has been trading this level. This is the most traded zone. And we did see a large trade in the previous market day, which we already reported on. But it gets a little bit more interesting because there's more than one now. There's quite a few. The sixth largest position over the last 2 years for the Direxon SPXS, which is a 3X bear fund, was just placed. The last time we saw one this large, we ended up moving up, which of course means that the market ended up selling off. So this is a 3X fund. Often they are there for very fast moves. However, we did see one of these just recently that didn't work. Of course, here is the UltraShare short QQQ. We saw a huge trade come through and it went down. So was that profit targeting? We don't know. Maybe it was. Maybe they're still in that position. But we saw another one appear just over the last 24 hours. So again, this position seems to be getting traded pretty heavily. And it's not just on the Qs. It's not just on the S&P 500 we're seeing it together. We're also having it on semiconductors. Here's ProShares Ultra Semiconductors USD. And we've seen this happen before where we had large transactions at the highs and the lows. And while it doesn't instantly necessarily react, we do see positioning over the next couple of days and weeks tend to come through. A very interesting chart and one we should be paying attention to. We also saw it on Apple the other day. And since then, Apple has, of course, rallied back to, again, the 61.8. It's good to see the biggest stock get to this level because it seemed like that wasn't necessarily possible unless the market started to chop, which is exactly what it did over the last 24 hours. All right, well, let's jump into options and let's have a look at some of the largest options trades over the last 24 hours. And I think these are pretty big, actually. The single stocks were getting quite large. NVIDIA traded massive amount of calls. We also saw the Qs trade massive amount of positions. In this case, there was actually more puts put through than calls. And then we have Johnson & Johnson, Zoom, all of these hyper stocks getting a little bit more of interest. And funnily enough, out of nowhere, iShares Silver Trust comes through with a 1.63. GDX as well, finding some significant strength. So that's the gold index over the last 24 hours. Will it be able, though, to hold? Well, we'll look at gold very soon. But I think the most interesting thing was that while individual stocks were having some large day trades, overall options volume was down. 39.9 is expectation, 37.3 was the day, 48% puts, 52% calls. So pretty even split. We're not seeing that kind of buy the dip reflex as strong as it was. The last 24 hours marked a pretty good session for things like technology. And in general, we had a market that was, doing okay. And it wasn't really getting defensive buys. Usually you'd like to see things like staples, healthcare, utilities getting picked up if it was about to sell. We didn't see that in the last 24 hours. We've also gone over the last 5 days, gold, solar, clean energy, all of those have been the best. And solar seems to have potentially found a little bit of a bottom, which we'll discuss later on today's video. But let's get into the charts. Everyone's going to start talking about no recession. The question is, should we actually be concerned when everyone talks about it being no recession? Well, we've talked about this many times, and basically what we're looking for is for yields to go back below inversion. That is back below 1%. If that does happen, that's when we should be scared. When everyone says, oh, it's not coming, generally the statistics show that coupled with unemployment increasing is usually a very bad sign. And that means a recession is usually around 3 to 6 months away. So we'll be paying close attention to these charts moving forward. But you should also set your alerts just in case for non-farm payrolls. Number one, set your alerts at 5.1% for the US 2-year. US 10-year is worthwhile setting alerts at above 4.365. And if any of those things happen, we go into what we call the fear of the unknown. And that's usually where you'll see markets sell off. Now, if you're a bull, all you want to see is continuation to the sell side, and that should help to rally markets. Though I think the only reason that yields are going to go down is going to be weak jobs numbers. So technically, it's kind of like bad news is good news in this market at this stage. Let's go over to treasuries. Have we seen a switch of trend? Well, everyone's bullish on treasuries, and I do like the zone. There's no doubt. I mean, we basically hit straight into the lows. It's a clear support level. Everyone's talking about it. I still think it's possible to flush to 88.90, and I wouldn't be unsurprised if that happens eventually. But do watch 97.38. If we do end up taking that, I think pullbacks will be met by buy demand, and that could be actually the low for treasuries across the board. It's been a while since we've taken a look at junk bonds, but we haven't broken out of the range, so that's why I haven't been doing it. So junk bonds have improved in recent days, showing that this rally could be real, and we're just basically trapped in the range. So until we break out of that, we won't really know that the markets are feeling super happy or super sad about what's going on. The volatility of the volatility continues to get crushed. Basically, this is similar to what happened in March, and it marked the bottom was in for the market at that point. Will it do it this time? Something that we do look at. This is the VVIX, and of course, it's on the chart. Another one that we watch is, of course, this, which is percentage of stocks above 20-day moving average. Well, it turns out that the percentage of stocks above the 20-day moving average has increased to a pretty significant level. Now, it needs to sell pretty much right now for this not to be a proper rally. And the reason is because when you look at previous ones, you'll see that when the pickup happens, it's relatively small and then it instantly turns back around. It's usually a fast, sharp, big move, hits that 20 moving average, all the stocks go above it, and then we get to around 50 and we start to turn. Notice where we are right now, 50. This is really a key point. If we take a look at the percentage of stocks above the 50-day moving average, that started to turn up as well, which is okay, but it needs to stop right now if bears are going to get control of this market. The skew also went from getting crushed to a massive increase. Interesting. This just means this is a very different time to what we've usually been having recently, which has, of course, been bears more in control. The skew put a total turnaround on that over the last 24 hours. So showing again that maybe the bulls really have got this market at this stage. What about metals? What about iron ore? What about copper? They continue to remain incredibly trapped in the forward contracts. And that means that we're waiting for potentially China stimulus. And actually, the China stim packs are coming back into the market. I will share that chart today. Don't worry, I'll put it over on the Twitters. Now, dollar index, what's going on here? We go back to mean reversion in terms of the daily. So we hit the daily 20 moving average, and we actually made a new low. Now, this went underneath our 102.94. So that marks that now if we get returns on the dollar, that we should be looking at swing shorts on this pair. And that's a really interesting point. This is something that we didn't see until just recently. The dollar's been so strong. It's clipped every single zone, just kept going bullish and bullish and bullish. But it looks like maybe this is too much for it. Of course, yes, it has rejected off the daily 20. But at this point, you'd have to think that rallies on the dollar index could be met by sell demand. Things like 103.50 and, of course, our 103.90 zone will be watched quite closely over the next couple of days. Gold, therefore, did pretty well. Gold managed to rally up to 1944. I still think 1960 is very possible here for gold. But what I'm more interested in is gold stocks. Take a look at GDX here. It took a new high. So it broke through our key level here at 929.80. And we expect gold to actually weaken off here a little bit. But I'm very interested in what happens here between 28 and 28.50. I think gold is looking a lot better. And if we, of course, do end up seeing bad unemployment figures and that pushes yields down, expect gold to do quite well in a situation like that. Bad yields or declining yields, gold becomes more of an attractive asset. What about oil? Well, oil is still hovering around this high. A lot of people are calling this a breakout. I don't blame them in the aspect that it actually did get a close daily above this zone, which can mean that, of course, we are going to rallies. I'm not too sure about that. I would call it me to be very neutral. I do think that there's still a very good chance that bears could take control at this level like they did last time because it took down these lows. But the problem with those lows was that we just saw that instant wick twice off it. So because we saw an instant wick, we're not really too comfortable with that break being key. This is the critical area. If we update structure, we see something, of course, we'll update it here on the channel. Let's now get into stocks, single stocks, before we go indices. And AAPL, the big